Continuing to watch, the Coinbase premium has turned negative, and the SSR has hit a 2-year low. Is Bitcoin unable to fall any further, or has it not dropped enough yet? After 3 deep corrections of over 20%, has the market entered a decade-long war of attrition? With both traffic and cash in hand, can Base Chain become a dual powerhouse in both Layer 2 infrastructure and content? It's Thursday, December 25th. This is the BitcoinTV Chinese channel, Billion Hizai. I'm Michael, wishing everyone a Merry Christmas and greeting you from Singapore. Let's first take a look at the must-watch data from the past 24 hours in the crypto space. This round of Bitcoin's market movement wasn't caused by panic selling, but rather by a lack of buying power. Looking at the price action, after coming down from the historical high, it's been a period of structural adjustment. Every rebound fizzles out just as it starts, so the issue isn't that the selling is particularly aggressive, but that there are simply fewer buyers stepping in. This year, US ETFs have attracted about $1.4 trillion in total, but most of that money has flowed into stocks and bonds. Although crypto ETFs are relatively small in scale, they have still managed to maintain a steady net inflow. In fact, Bitcoin spot ETFs even look more like long-term holdings that rarely move, a kind of set-it-and-forget-it allocation. So the awkward part is right here. The money has come in, but it hasn't created any new marginal buying power. As you can see, after the end of the year, everyone has already priced in the positive impact from ETFs in advance. High interest rates are suppressing risk appetite, so naturally, the market has started to deleverage. Let's also look at Coinbase's premium, which has been negative recently. This indicates that spot buying in the US is also like this. This isn't a systemic blow-up, but rather a temporary shortage of demand. So in the short term, Bitcoin will definitely move sideways and gradually weaken. Once new demand returns, the market will definitely restart. Let's also look at Bitcoin's stablecoin supply ratio, SSR, which has now dropped to 11.1. This is the lowest level since January 2024, and compared to the peak of 19.41 in July this year, it's been cut in half. So, what does this indicator tell us? It shows whether Bitcoin is expensive and whether there's still a lot of money in the market. The current data gives us a very clear answer. Bitcoin has become cheaper, but stablecoins haven't followed suit. In fact, there are even more of them now. In other words, this isn't simply the result of a price crash. Instead, after the deleveraging and clearing of positions, a large amount of money is sitting on the sidelines, untouched, ready to enter the market at any moment. This kind of data structure is more like a gun loaded with bullets, but the trigger hasn't been pulled yet. Although the downside risk is being suppressed, at this stage, we're approaching a phase where accumulation is happening and the supply-demand relationship is being rebalanced. So, while there's a possibility of sliding further into the abyss, it's actually quite unlikely. There's also some worse news. The current market looks a bit like someone has started catching falling knives, but hasn't caught enough yet. Institutions are pulling out, short-term investors are cutting their losses, but there are also subtle changes happening on-chain. According to the data, what is the current proportion of UTXOs aged 12 to 18 months? It's 9.67%. So this group basically bought in at the highs of the last cycle and could not sell during the bear market, so they are passively holding these midterm positions. If this proportion increases, it indicates that the market is shifting from a phase where people are exiting as quickly as possible to a stage of helpless accumulation, where those who are stuck are just holding on. But if you compare this to the real bottoms in history, the data becomes very clear. In 2015, this figure was 44%, in 2019 it was 43%, and in 2022 it was 30%. So right now, this number hasn't even reached double digits. It's only just getting started. So before the midterm accumulation of positions really builds up, Bitcoin's price will likely still have to withstand a period of short-term stop losses, institutional deleveraging, and the pressure from sentiment cooling off. But to reach what people call the true bottom of a Bitcoin bear market, there may still be a very treacherous road ahead. Alright, if you're a new viewer just tuning into our channel, I want to let you know that this channel is here to help you quickly understand what's happening in Web3 in just 15 minutes a day. We keep an eye on the small details of big projects and the big issues of small projects for you. So, for today's top story, let's take a look at whether the so-called curse in the crypto world, the one that's been recited every 4 years, is really about to be broken. Does the 4-year Bitcoin halving cycle still hold true? Matt Hougan from Bitwise poured cold water on the idea, saying that the halving no longer has the same powerful impact as before. Interest rates can't fluctuate wildly anymore, and the market is no longer so easily swept up in collective frenzy. The market is no longer simply bullish or bearish at the drop of a hat. Instead, it will gradually turn into a prolonged war of attrition. In the future, the crypto world won't be about who can time the cycle best, but about who can endure and hold out the longest.
Matt Hougan pointed out that the market logic previously driven by speculative sentiment and the halving narrative is now being replaced by the systematic entry of institutional capital. the formation of global regulatory frameworks, and practical applications such as stablecoins and asset tokenization. These forces advance slowly, but are more enduring. Since the approval of the Bitcoin Spot ETF in January 2024 until the end of the year, the price of Bitcoin has risen by a cumulative 93%, during which there have already been 3 deep corrections of over 20%.
I kind of subscribe to the view that there's probably a chance the 4-year cycle for Bitcoin is coming to an end because of the way institutional adoption of that thesis is happening. So now you have institutional and essentially permanent holders of Bitcoin entering the market.
Matt Hugin also pointed out that the old logic supporting an inevitable crash in the 4th year is falling apart. In 2026, interest rates are more likely to decline rather than surge, and 2025 has not seen the kind of extreme frenzy that occurred in 2017 or 2021. This means that the key fuel needed to trigger a traditional style crash is now clearly lacking.
To some extent, I agree with this viewpoint. If you look at Bitcoin on a yearly candlestick chart, has there ever really been a bear market in the past decade or so? This is an asset that has just kept rising. Over more than 10 years, this long-term battle has shown the market that the crypto space has matured. So now that institutions have entered the market, it's unlikely that we'll see those legendary 100-fold surges again in the future. But it's not like we should be calling for it to go to zero at every turn, right? So the market is more like a marathon. If this narrative holds true going forward, then pullbacks will become very frequent. Drops of 20, 30, even 40% will happen often during this stage. So if this narrative is what matters, it's not about who can guess the top or catch the bottom, but about who can withstand the volatility and endure the loneliness. In this trend, the thrill of wild price swings will definitely be less, but there will be more of a sense of reality. This actually shows that the crypto assets we believe in are starting to resemble mature assets, doesn't it? Alright, next let's take a look at Base Chain. What is Base Chain? It's a sidechain of Ethereum, but who is backing it? Coinbase. So from the very beginning, Base was born with a silver spoon in its mouth and came with its own traffic. While most public chains are worried about where to find new users and are burning subsidies everywhere, Base's monthly active trading users start at 9.3 million. So while most layer 2s are scrambling for liquidity and users in 2025, Base Chain is already far ahead.
Data shows that revenue on Base Chain jumped from $2.5 million in December 2023 to $75.4 million so far in 2025. Its market share is about 62%, with a total DeFi TVL of $4.63 billion, accounting for 64% of the entire Layer 2 market, and its share has continued to rise throughout the year. Applications within the ecosystem have generated a cumulative revenue of $369.9 million, with the leading DEX Aerodrome contributing $160.5 million. The success of diverse applications such as the AI agent platform Virtual further demonstrates the health of the Base ecosystem and scalability.
After gaining popularity on Layer 2, Base is no longer content with just building infrastructure and collecting tolls. Its vision for Base App is quite ambitious. As long as you post and contribute creative content, you'll be rewarded with tokens. But what's the reality? Out of 6.52 million pieces of content, after filtering, only about 17,800 posts still meet the value standard after 48 hours. For most people, their content isn't even worth a cup of coffee. So the next step for Base is no longer about whose hardware is more powerful, but whether the content, or rather your tokens, can truly feel human and whether they can build an emotional moat. That's why this experiment by Base is so important. What's at stake? If they fail, it means that in a decentralized world, even with Coinbase backing you, influence isn't something you can just buy. So this whole drama is highly symbolic. Here, there are myths of getting rich overnight, as well as carefully woven schemes. This is a dark forest of chaotic development, but it also nurtures a lake of hope leading to the light. The destination of faith is freedom. The endpoint of consensus is equality. BitcoinTV takes you through the fog to see the future, and together we'll slowly become wealthier. The total market value of the crypto market has surpassed $3 trillion. Will ETF outflows trigger a systemic sell-off? With a strict ban on privacy coin trading and cryptocurrencies classified as foreign currency, is Russia truly opening up or tightening control? Lately, the crypto world really feels like it's entering a winter. Bitcoin and Ethereum related ETFs have been seeing continuous outflows, which is pretty straightforward. It means institutions are packing up and leaving, so naturally, the market is getting tighter on funds. Glassnode's data makes it clear. The ongoing ETF outflows show that institutional enthusiasm is cooling off, and some institutional funds are simply choosing to cut their losses and exit. Actually, this was to be expected, because since mid-October, when prices started to pull back, institutions have been finding it hard to hold on. Previously, ETFs were driving both sentiment and prices forward, but now institutions are hitting the brakes. So, if we want to get through this round of correction, I believe it won't last as long as the bear market in 2022, which dragged on for 2 years, but it will still be longer than most people expect, at least 4 or 5 months.
According to the data, CoinGlass shows that Bitcoin ETFs have seen net capital outflows for 4 consecutive trading days, reflecting a continued weakening in overall institutional sentiment. However, BlackRock's iShares Bitcoin Trust remains one of the few exceptions among industry leaders. Over the past week, it has maintained a slight net capital inflow.
Last month, after reaching a new all-time high institutional buying, which was once a critical source of support holding up Bitcoin's price floor, is no longer present. Those spot ETFs just experienced their worst week of outflows since February.
Copy Selector pointed out in its latest report that selling pressure on cryptocurrency ETFs has resurfaced, with total outflows reaching $952 million last week, and investors have withdrawn funds in 6 out of the past 10 weeks. Against the backdrop of intensive institutional capital outflows, the market remains under pressure, and this situation is unlikely to ease quickly.
We have to admit, IBIT is really resilient. Even when the market isn't doing well and returns are negative, money keeps flowing in. This just shows how strong BlackRock's brand is. IBIT has now attracted a total of $62.5 billion, leaving other similar ETFs far behind. Even Bloomberg's Eric Balchunas remarked that, although IBIT hasn't performed well this year, it still ranks 6th in terms of fund inflows. Do you know whose record it has surpassed? It even surpassed the gold ETF, which had risen by 64%. So, being able to keep attracting funds during a downturn like this shows that IBIT, or rather BlackRock, functions more like a long-term allocation tool held by institutions. Once the market picks up, the potential is enormous. Now let's examine Russia. Russia has suddenly changed its stance. Earlier, the central bank opposed cryptocurrencies, guarding them, but in December, they announced plans to lift the trading ban in 2026. However, this ban lifting must occur in a controlled lab environment. They seem to be loosening up, but in reality, they're implementing a dual-track system. With Trump returning to the White House, global tech competition is heating up. Western sanctions pressuring Russia mean they want to use crypto to ease capital restrictions, but are unwilling to give up financial control. So this lifting of the ban isn't about letting things run wild, but a carefully designed system where crypto can be used. But how it's used is entirely up to them.
The dual-track system means managing people differently. For retail and non-qualified investors, the central bank set an annual trading limit of 300,000 rubles, about $3,846, and they must pass a risk assessment. Only Bitcoin and Ethereum trading is allowed. This is to satisfy small-scale speculative demand and to prevent large-scale outflow of rubles.
I think that it is important to remember that the risk of that needs to be kept in proper perspective, though it is widely known that cryptocurrency is actually highly transparent and open.
Qualified investors are not subject to quota restrictions, but they are explicitly prohibited from trading privacy coins such as Monero, effectively blocking the flow of anonymous funds. At the same time, Russia has not changed the fundamental nature of cryptocurrencies. The proposal still defines them as foreign currency assets and strictly prohibits their use as domestic payment instruments. The core of the domestic payment system remains the digital ruble.
So, as a side note, you see that even the Russian government has stated that Monero cannot be used for transactions or as a payment tool, and many exchanges are also delisting Monero. So in the privacy sector, who is truly private and who is just pretending to be private? It's pretty clear now, right? You should have a sense of which tokens are worth holding for the long term. Let's get back to the main topic. In fact, what Russia is really keeping in reserve isn't cryptocurrency. It's the digital ruble that they truly care about. So why are they loosening restrictions now? It's not that they really want to turn the whole country into a testing ground for cryptocurrencies, but rather they're treating crypto as a tool for international market settlements, while domestically it's still the ruble. As you know, in September 2026, For all businesses operating in Russia, if your annual income exceeds 120 million rubles, accepting digital rubles becomes mandatory. The law stipulates that if you operate without a license or evade taxes, you face criminal liability. The maximum penalty can be execution. So, within Russia, they are implementing this ruble system, while externally, they are using cryptocurrencies to break through their financial blockade. Will it succeed? We'll have to wait and see. Now, let's look at the news flash.
Tom's point is very simple. When the market starts to move, first look at gold as the main indicator. Once the sentiment and capital are in place, Bitcoin is often the one that surges the fastest and strongest. There are concerns from the outside that prediction markets might disrupt competitions or manipulate elections. Vitalik Buterin came out directly to calm things down, saying there's no need to be so nervous. Prediction markets aren't that powerful and won't overturn the fundamental rules of sports or elections. Holy Market was held back a bit by a third-party identity verification service, resulting in a minor bug that only affected a small number of users. Fortunately, the platform detected it early and fixed it quickly, so the issue has been properly resolved and hasn't escalated further. The renminbi was quite strong today, breaking through 7.01 against the exchange rate and reaching a new high since the end of last September. It's finally back in the strong range after a long time, and Hangzhou Yunshenchu Technology Co. Limited has secured another large sum of money. In the pre-IPO round, the national team took the lead, with major internet companies following suit to show their support. This indicates that the AI sector isn't just a hot topic. There's real capital betting on the next big move in advance.
Recently, Li Kang heard a saying that the more he thinks about it, the more he agrees, and he wants to share it with those of you still in the workplace. He said, don't fight for position in a makeshift team. What's the point of going to work? It's to buy your freedom as soon as possible, not to become the star player in there. Just like someone said in the comments section, the purpose of driving is to arrive safely, not to spend the whole journey trying to educate reckless drivers. Hard work is never about standing out among a flock of chickens, but about one day leaving the flock entirely. Many times, the reason we feel drained is because we get too caught up in a specific part of the process, endlessly worrying about how troublesome it is. Of course, problems need to be solved, but don't get stuck on the details. Instead, stay clear-headed and keep your focus on what your goal really is. When you zoom out, you'll realize that what you need to do is get through the swamp, not fight every crocodile in it. Remember, the goal is to leave the scene, not to win at the scene. If you get it, feel free to give a like. All right, that's all for today's program. Here you'll find our membership benefits. We hope you'll join as a member so we can hustle together, gradually get wealthier, and keep pushing forward. A8, A9, let's work hard. See you tomorrow.